Hey everyone, welcome back to the Your Money Life podcast. We're on episode 314 of the pod. So make sure wherever you're listening, you like, subscribe, 5-star rate, and review this podcast. Also follow on all the other social medias, especially TikTok, where we're trying to do daily videos going through different concepts, whether it's personal finance, current news, things that happen during the week that you should want to catch in real time, and then probably get a recap of it on this pod. So make sure you do that. Let's jump into it. And we always start by giving a good hard look at the markets and what the markets are telling us. So let's jump right into that. First and foremost, what an incredibly wild trading day. If you saw the market kind of started out lower, quickly traded lower today, I'm getting this episode out after the market is open. So we'll see how this kind of ends up today, but we are seeing somewhat of recovery and buyback of the bottom of the market here of the day. And we've gone from lows to now it's starting to kind of correct somewhat. So we'll see how that plays a part here in the rest of the market and the rest of the day, trading day. So that's the big move. And again, there's been a lot of sharp moves with tech names. So let's jump into some of what those names are and what they're doing. Alphabet was one of the latest companies to report earnings. They had a sharp increase in AI spend. That was the big thing the market wasn't expecting, that there was a sharp increase in the spending that they projected that they will do for AI in 2026. So that did spook some investors. They were calling for 2026 capital expenditures of up to 185 billion. But again, let's actually look at how it's trading now after their earnings came out yesterday after the market closed, which would have been Wednesday. Let's see how they're actually trading now when the market is now open and people are digesting news. They're starting to make a little comeback. The sell off is starting to recover slightly. Again, we'll see how it all shakes out as we get to the later in the trading day, but they are starting to pull back from that sell off that was spooking investors about their AI spend. But um, Broadcom jumped almost 2% following the news of Alphabet spend. Alongside Alphabet, Qualcomm came under pressure. So Qualcomm, another tech company, came under pressure, sliding 7%. They posted weaker than expected forecasts because of a global memory shortage. And so there's different companies, coming out. But again, when you talk about Alphabet, they did beat on earnings expectations. They have a really strong business. So again, all these minor shakeouts of tech and different things are actually, buying opportunities long term. So, for people that are thinking about how to approach this, there might be still more volatility and corrections in the near future, but I think these are buying opportunities for long term investors. We're not going to see very often with the way the market has been elevated over the past, even look at Google's long term 1 year chart, 67% return over a period of 1 year, heavily increasing in the summer of 25 and steadily just on an upward trajectory. So these are just many buying opportunities that people get that may not come back around because you're looking at tech eating everything in the future, tech eating everything in the future, tech eating market share, tech eating stock market share, tech eating jobs. Like you're just looking at what's going to happen in the future. And so these minor shakeouts are actually really, really interesting buying opportunities that I believe are there for people to take advantage of. In other news, we'll talk about Bitcoin a little bit. Crypto has taken it's in bear market officially. And what does that mean, right? Like people are like, oh, crypto is in bear market territory or it's in a bear market cycle. And so let's read what they're saying. Bitcoin dipped below 70,000. The Bitcoin rout deepened on Thursday as the world's largest cryptocurrency briefly dipped below 70,000 for the first time in 15 months, leading investors to fear that greater losses loom. The market is currently navigating a crisis of faith. This is from asset manager Xiling Tang that told Bloomberg it's shed more than 40% of its value since October, and analysts cited by Reuters linked the current off to the nomination of perceived fiscal hawk Kevin Warsh to the chair of the Federal Reserve on fears that he'll shrink the central bank's balance sheet. So interestingly enough, again, this is a standard cycle for cryptocurrency and especially Bitcoin and Ethereum. They have a standard 4 year cycle of boom, hype, hysteria, followed by bear market that will last. And this bear market, we're expecting to be actually a little bit shorter than normal. You usually get a year-long bear market where everyone stops talking about cryptocurrency, people have liquidated, did all that stuff. But you're gonna see it be a little bit shorter. So I think people will start to really, things will start to turn for crypto in second quarter of this year. Second quarter of this year is a good estimate. Could be, give or take. Well, we've been, on a personal level, we stopped managing it for clients because of this platform shutting down, but we still believe clients should have a percentage of their assets held in a couple of strong cryptocurrencies. And on a personal level, that's what I done. My average buying for Bitcoin is way below the number that we even see now, right? So it's like my average price point entry is way below 70,000, and I'll continue, on a personal level to buy cryptocurrency, especially during this dip. This is a great time for people, especially people that are buyers and holders and not traders. That are buyers and holders of solid assets and not traders of these assets. This is actually a really, really good time. Yeah, it seems like a little bit of liquidity has been taken out of the market, and there's nothing wrong with that, right? There is nothing wrong with some liquidity moving out and shaking some people out, and longer term holders can rest assured that they can hold for a while and stay the course. And that's what we implement for ourselves and my clients, and that's what we're gonna do. Let's look at like another thing economically that's actually affecting what's happening now. There is layoffs happening. U.S. marks worst January for layoff announcements since 2009. So last month was, the worst for job cut announcements since the Great Recession. This was from the outplacement firm Challenger Gray and Christmas. They said Thursday U.S. companies announced over 100,000 job cuts at nearly 120% increase year over year. Hiring intention, so companies that were intending to hire, meanwhile, fell 13% from the year before, hitting their lowest level since 2009. Almost half of the January reductions were linked to three companies, Amazon, UPS, and Dow. And now I think you can throw, well, that would have been this month. This month there was news of Washington Post letting go of some, incredible journalists, it seemed like. So, you're seeing again, I talked about this on TikTok, you're seeing a slowdown. It's not an all at once halt, but it's definitely a slowdown, I would say, in jobs and the market and the job market tightening. What's really holding up the job market, as I said on the piece we put out, was education and healthcare. Education and healthcare did see an increase, while every other industry seemed to see a decrease, or at least most other industries saw a decrease or were flat. So that's incredibly good insight. When we saw the payroll numbers come out for January, again, they were abysmal at only 22,000 increase when we expected, or economists expected, 45,000. And again, education and healthcare holding things up. And now you're getting this announcements of layoffs. So again, it's not a grind to a halt, but it's definitely a slowdown on what's happening in the economy. So 2026 off to a different, interesting start so far as economically. That's the big thing economically, what's happening. And we did talk a little bit about the tech stocks and different things. Again, we're actually seeing it in real time. Seeing in real time that we are. Let's go to our 1 day chart. Markets still having some bear in it, and struggling to fully get back. But, that's part of this today. Like that's part of what's going on is, all these different news information, earnings coming out. You're seeing the market have more volatility as we look at the QQQ, have more volatility than in prior times. We just kind of saw increasingly steady up and up, but now we're seeing a little bit more volatility across the board, and that's okay. I think these are going to be generational buying times for people in the market for the next few months. It'll be, if there's some sort of bear market, especially I think that's more, it's very probable that we already are on the crypto side. I don't see that already in the stock market side, but if we do, it's going to be generational buying opportunities for people. And that's kind of what you need to understand about longer term investing and how to approach it is being able to stomach different things that come in the market, right? There's themes that in the market that we'll actually talk about. We've talked about them plenty of times before, but maybe there's a refresher that we should do. about those themes in the market as well. So, a lot of interesting stuff so far. But it's again standard as usual. We've talked about mostly the bigger things that we need to talk about, but standard stuff. Let's go into that. The roundtable right now. Let's talk a little bit about some emotions that do sabotage financial outcomes. There are emotions that do sabotage financial outcomes. If you think about four big ones, the one is fear. One of them is fear, and that plays a lot in investing. That plays a lot in different things, but it's really just panicking during downturns, or that can trigger selling at a loss. Like selling at a loss is obviously the worst thing that people want to do, right? If you look at this QQQ chart, let's look at 2025. Let's look at 2022. If people panicked and sold here, look at all the gains that they missed out on. And then again, they'll buy back in here at the top, and they'll sell and panic right here and miss all these gains again. So like that's what triggers when people lock in losses, it's because of fear. And there's another thing, greed, right? Like greed has plays a part in financial outcomes as well. When you are right here and you could have been investing here, but you don't, and then everyone's telling you, "Oh, I just bought this," and and they only make moves right here because someone else told them. They chase the hype, they chase the stock, they chase something, and then that's what triggers them selling because they buy at the top versus having a long-term perspective, not thinking of just day trading for greed purposes, but just using it as a long-term economic viable tool for compounding returns in the future for decades. That's another trigger. It's that greed. That's an emotion. Loss aversion. There's a lot of people that just don't do anything. They avoid risk entirely. They avoid taking chances. They avoid investing because they think they're just going to lose all their money when history will tell you that's never happened. If you've been a long-term investor in just the market, you've no one in the history of the market has ever lost money doing that. But they'll tell you, oh, the market's going to crash and everyone's going to lose everything. And so they just sit in a checking their savings and they lose so much years of compounding. That's the emotion. Social comparison is another one. That's comparing yourself to what other people are doing, taking advice from people that are not actual certified or registered. And it'll lead to a lot of outcomes that are not for you. We'll say that much. And anchoring is another one that's less least talked about, but that's clinging on to an outdated opinion or price point. If you buy something because you heard someone talk about it, and even though it's not performing well, but you just like the company, let's look at Peloton, for example, just using it. You got to love the company, you love the bike or any something like that, but you just won't let it go. Even though you look at a 5-year price chart and it's lost 97% of its value, but you won't let it go because you love the bike. You love what's their names? Who's an instructor? Cody. Cody is sitting on RSUs that have devalued. All right. And the bike isn't going to fix that. Just a good example. But the point is, like, don't anchor on beliefs, make changes with information that's new that comes to you. You can make changes, right? And um, you can have a different perspective with new information. And so that's important to note. But those are the emotions that really trigger some potential bad outcomes if they're not anchored in and used the right way. Let's get a financial question of the week while we're at it. Question of the day and week: what is the median income for a full-time year-round American workers? What is the median income, not average, median income, excuse me, median? And the answer happens to be 63,000. This is the U.S. Census Bureau. And they asked, it's 63,000. That's not, yeah, 63,000. Folks, we did this pretty good this week. See Your Money Live podcast. We made sure we got this to you. Make sure you like, subscribe, 5-star rated review. We'll do this every week as normal, and we'll talk to you next week.